Hey, what's up, everybody? Thanks for joining me in this month's May edition of How's the Real Estate Market? Most popular question I probably get. So, figure I'd just dub my newsletter exactly that question. So, let's dig in because I go over the national spotlight, the state spotlight, and then finish up with the local spotlight for the San Gabriel Valley here in Southern California. So, with that being said, let's first take a look at this national spotlight, why we're not headed for a housing bubble. This seems to be a theme over the last really few months to say, are we in a housing bubble? Here's why we're in a housing bubble. And you get a lot of titles and headlines that tend to terrify more than they clarify. So I feel like that's a part of my job, is to help you make clarity of all this information that's out there. So here's why we're not headed for a housing bubble. Let's first dig into where we've come from. World War II is significant in the housing industry because that's really when we ramped up the building of single-family homes in the United States, and when people really started to value the investment that a home gives. So this graph gives you a visual as to what the housing market has done since 1945. And you can see that we had two downturns since 1945. One, the significant one in the mid-2000s. You'll also see just a little blip in there in the early 1990s. So these are the only two times in our housing industry that we've had depreciation in our houses. The rest of the time we've experienced appreciation, or even a bit of stagnation, to say, you know what, it didn't fluctuate really at all. And you can see that there early on in those 40s and 50s through those two decades primarily. Let's look at forbearance, because this is a topic that has come up, especially in the last month, maybe even 6 weeks, is what about foreclosures? Well, forbearance is a synonymous term to describe those potentially looking at the foreclosure process. And as you see in this graph, the initial forecast by some out there was we're going to have about a third of all homeowners out there experience some type of foreclosure in using the term forbearance. And so this is what our concerns are versus what reality is. So the initial forecast was, oh my God, a third of people are going to experience this with COVID hitting and with people not being able to afford payments, etc. Well, the actual peak was 8.6%, less than 10%, less than 1 out of every 10 people experienced some kind of hardship. That doesn't demean those that did. But then where are we currently? We're currently at just over 1%. Just over 1% of those individuals are experiencing challenging times still. So let's dig into that idea of foreclosures, because that did dominate in the mid-2000s. A lot of people couldn't afford their payment anymore. Well, forbearance numbers edging downward. So let's look at this since dating back to May 2020. That was right when the pandemic hit. That's right when a lot of unknowns and uncertainty hit the market of saying, am I going to have a job when I come back? What is my job doing right now? Are they laying off? What are they doing? Right? So you can see there the number since May 2020 has steadily trailed off. And now we've got the most recent numbers there in April. And that's looking at the millions of people that were in and currently are in forbearance and trying to work that out. Let's take another look and give you another visual here. 37% of those that went into forbearance are now paid in full. Almost 45% had workouts or repayment plans, right? And it's a non-issue. And now you have about 18% that are still in some kind of trouble. And unfortunately, that's any market, right? You're always going to have a slice of the pie that is always going to experience hardship of some kind, and people come in and out of that space, right? So nonetheless, it gives you a clear idea as to where we've been and where we are when it comes to those that are challenged with the potential of foreclosure. Why are we not seeing more people that are still in trouble? Well, it's because a lot of lenders don't want to inherit the house and the payment, and sitting on that situation. It's almost like we learned our lesson, and we figured out, meaning the lending industry, figured out that that's not in anybody's best interest. What is in the best interest is, can I work with the homeowner? So long as the homeowners are communicating clearly and are on top of things and are not putting their head in the sand, lenders are willing to work with most situations these days. So just something to be mindful of when it comes to foreclosures, as that was a hot topic in the mid-2000s, and that is certainly not the topic here in the early 2020s. Lending standards are nothing like the early 2000s. This gives you a clear graph and indicator as to what products were available and the borrower risk. So what that means is there were many more options for prospective borrowers of money there in the late 90s and early 2000s. There were a lot of risk involved. And now those products either went away and or people are being better educated pertaining to what the products have to offer. So you're not getting as many misleading opportunities that are putting people under, right? So there again has to deal with the lending space doing a much better job of setting a standard first and then maintaining that standard second. So in which case you have less foreclosures. Why? Because people are better educated and are able to have to pay or not pay. They're having to show what assets they own, yeah, and show proof of their income. That was not the case in the mid-2000s, unfortunately. So again, we've learned our lesson. This is why we are not looking to see ourselves to repeat the mid-2000s. Foreclosure activity at an all-time low. So for those of you that may say, oh, I heard that we're up 157% or whatever numbers, that's because we're coming from a space that we're at an all-time low right now. So point being, we're in a very healthy environment, especially this gives you a very clear visual as to where we were versus to where we are. So it's important that we don't just get lost in titles and headlines saying, oh, we're twice the amount of foreclosures that we were a year ago. Look where we are, look where we were, right? Have a steady mind and a steady idea as to what the context is versus just what the title reads. Because we're in a very healthy space when it comes to foreclosures. Don't get me wrong. If you're in this situation, it doesn't make it okay, right? And we want to help get you out. But with that being said, just because we are going to see maybe this tick up, it doesn't mean we're in a bad space. So again, context matters. Lending standards are tighter since the crash. There again, and I mentioned this just a couple slides ago, and I'll reiterate it again. The amount of risk involved is not nearly as high as what it was. And this tells you with those that were given a loan and lending opportunities with a credit score of 620 or below, again, you can see where we were to where we are, right? It's not to say you can't get a loan if you have a credit score less than 620. You can get one as low as 580. But again, that means your interest rate is going to be a little bit higher, the lower score you have. Why? Because you're a riskier individual, unfortunately, based on your history of repayment for the things you've had the opportunity to repay. So again, we're not in as risky of a time, and we're in a much healthier lending environment than what we were. Mortgage payments virtually unaffected. This is an interesting one because we talk about, well, what about those that refinance and cash out? You can see the last 2 years, $66 and $34 was the fluctuation to what people's payment was to what it currently is. You can see there in the mid-2000s, people cashed out, and the difference in payment of what it was to what their new current payment is, you're talking about thousands of dollars was the difference, right? People essentially use their homes as ATMs to buy extra stuff, whether it be jet skis, vacations. That's not the case today. We're in a different place. So I'm not presenting my opinion to you. I'm presenting facts to you to say, here's where we are and here's where we were. And here's some black and white information to show that versus just try to tell you and hopefully you remember it, right? So again, mortgage payments virtually unaffected, especially these last 2 years. What does that mean? It means people are sitting on equity. So even for those that are going to find it challenging to make payments this day and age, they're still going to be able to get out of that house with the amount of appreciation that they've been able to accumulate over the last few years. So again, not to discredit anybody that's in that situation to potentially have to foreclose, but point is we're at such low inventory that it's just going to get snatched up, and they have the equity that's built up the last couple of years to play in their favor. Versus mid-2000s, we didn't have that equity that a lot of people hoped they would have. So what's ahead? I showed you where we've been. Let's take a look to where we're going. Impact of rising rates. That's a popular topic, right? Interest rates are going up. What does that mean to home prices? I've shared this graph a couple times, I know, in recent in recent monthly reviews like I'm doing now. Wanted to share this one again because it's important to note. Just because interest rates rise, it does not mean home prices go down. And you can see since the early 90s, home prices have still gone up, even with interest rates ticking up. And today we're still seeing interest rates go up, unfortunately, but home appreciation continues to rise as well. Biggest driver behind that, supply and demand. Our inventory is so low. But I just wanted to show this visual because I think it is an important one, again, to share with where have we been when it comes to rising rates in our history. And this gives you a clear idea as to what home prices have done in the times that interest rates have risen. Estimated home price performance. So this is looking at a 5-year snapshot. What are home prices projected to do by the experts this year and moving forward? And you can see we're projected to be in a very healthy, things are going to decelerate. Appreciation is expected to decelerate, okay? But it's not to depreciate. Those are two different D words. Decelerate means slowing down, right? Our year-to-year average for appreciation is in and around between 3 and 4% as a norm nationwide, right? So we're still projected to go 2 times above that this year by ourselves, and then gradually slow down to a more quote unquote normal level there from 23 to 26. Point being, we're not expected to depreciate with our home prices. Okay, so they are expected to go up still. Again, projected by the experts that see these numbers day in and day out, and to say what does our climate look like currently? What foundation are we built on currently? And what does that look like for long-term growth? Cumulative house appreciation by 2026. So I just broke it down year by year. Well, optimists would tell you we're going to grow almost 50% in their opinion over the next 5 years. The pessimists say just 10%. Well, the answer is it's probably somewhere in between. And there's your average in around 26% between the pessimists and the optimists. So again, point being, not even the pessimists are expecting home prices to depreciate. Again, will they decelerate? Yes. Why? Because we've hit record amounts of appreciation the last few years. And that's not sustainable. And you pessimists are right to say that's not sustainable. With that being said, we're not expecting to see home prices to depreciate, meaning lose value, and go from being worth $1 million to $800,000 anytime soon. So things to be mindful of where we gather our facts and information. Home price forecast for 2022. Touched on it, and this just gives you an idea as to, well, who are the experts? Well, you can do your own digging here because you got Freddie Mac, you got CoreLogic, you got NAR, you got Fannie Mae. Point being, all of them come in around 9%. Right? The first graphs I showed you in January were in around 10%. So it's fluctuated 1% since these interest rates have ticked up as quickly, unfortunately, as they have. Nonetheless, homes are not projected to depreciate. Okay, they're still expected to appreciate, and this year alone, 9%. So what does that mean for those of you that are on the fence, say, I want to save more? Well, I'm going to use LA because that's where I live. Let's pretend a home is worth $1 million today. What does 9% appreciation look like? Right, that's $90,000 that it's going to be expected to jump. So if you can't save $90,000 this year, you're not alone, by the way. Just know, are you able to save as fast as a home is appreciating? Because if you're not able to save as fast as homes are appreciating, well, if you can afford to get in now, my suggestion is talk to an agent and get in now, right? Otherwise, you're still going to continue to be priced out of the market just by appreciation alone, unfortunately. So I hear that one a lot. Hey, we're going to wait for prices to drop. No one's expecting them to drop. And if you can't save as fast as homes are appreciating, you're still losing, unfortunately. So the faster you can become a homeowner, now you can take advantage of that home appreciation, right? So just something to be mindful of as you navigate your own individual space. Based on the current estimate for the peak Fed funds rate, 3.25% to 4%, the 30-year fixed mortgage will likely peak between 5 and 5.7%. There's some variability in the relationship, so we might see rates as high as the low 6 range. So this all depends on inflation and the Fed funds rate, but I don't expect rates to move much higher than the current rate, although 6% is possible. And that was from Bill McBride at Calculated Risk with a blog there. So that's what some of the experts are saying. Affordability. This is a hot topic. Homes are unaffordable. Are they? Aren't they? Well, let's take a look to see what numbers are. New data from the Harris poll show 84% of Americans plan to cut back spending as a result of price spikes. More than 70% of respondents said they're feeling the effects of inflation, the most in gas prices and groceries. This is understandable. We see it and hear it a lot in the news, understandably, and we're all feeling the effects regardless of where you live. What does that mean? Well, change in mortgage payment. Let's take a look at that within the housing industry. If you got in January 2021, you're able to get potentially, depending on your credit, of course, 2.73 was a realistic percentage. Look at what that monthly payment is. You jump to October 22, 5.5 is, I mean, we're there right now, but let's just pretend if it's 5.5 come October, look at the difference. What is that, almost $500? So again, should I wait? Should I get in now if I'm qualified to get in now? Well, what does your pocketbook say to say, are you able to afford if things change? If interest rates change, are you able to make up that difference in your monthly payment? Those are real numbers to think through based on what your market's doing, because understandably LA is different than a market in Washington, different than Nebraska, different than Texas, and so on and so forth. Right? So just be mindful. Rates do fluctuate that monthly payment. How much? Gives you an idea. Connect with experts in their field. It's a free opportunity to know where you're at and know where you might be. Affordability is approaching historical levels. So here's what this graph shows. If it's below that dotted line, it means homes are more unaffordable. Okay, we just went from a very affordable moment in time, mid-2000s. Homes are very affordable. Why? Because they depreciated in value. So you can see we're right at that dotted line. So although homes might be becoming more challenging to afford, they're not unaffordable altogether. They're just less affordable. It's relative, right? But it doesn't mean all homes are unaffordable. It just comes back to where maybe you want to give up. Is it time in the car? Is it the amenities? You wanted a 4-bedroom and maybe you need to look at a 3-bedroom just for now. It's not maybe your forever home, but it's your right now home. What do you want your lifestyle to be like? What are you maybe willing to sacrifice and give up for the next 3 to 5 to 7 years? And then maybe you're able to make a move after that. Decisions to think through. The average consumer is spending an additional $429 monthly for items other than shelter. Meanwhile, average weekly wages rose just $212 per month, so the consumer is short by $217 per month nationally. This means that the average consumer will be looking for a home that is $42,000-ish cheaper. Unfortunately, homes are getting more expensive, not less expensive. So again, decisions to make as an individual trying to navigate your individual situation within the housing industry. But again, important information to know as we try to figure out what are we going to trade. Do I have a relevant market opinion based upon facts? I think that's an important question to ask yourself, because we see all these headlines, again, that tend to terrify more than they clarify, but we take them as facts without knowing the context, right? So just be mindful. Reach out if you have any questions. Let's jump now into the state information. I'm in California, so I'm going to shed some light in the California space here briefly. New record high median cost for a home in California. Unfortunately, that's what we're at. That's what we're seeing. Over $880,000 is the average home in California these days for a single family. That's not condos and townhomes. That's single families. Nonetheless, that's our reality. Average days on market, record low 8 days. You might say, well, Nick, I saw that in March. That's a misprint. Nope, that's the same. It was the same in March and April 2022. 8 days in market is the average days on market for a home. That's the world we're living in right now. It's a fast-paced one. Consecutive months that at least 50% of all homes sold over list price. We've now stretched that from 19 to 20 straight months. That's what competitive looks like out there for those of you that are looking to make a purchase. Monthly inventory levels, the 1.6, 2.0. Here's what you really need to look at. Look at that gray number, 6 to 7 months. That's your neutral market. You can see that California's hasn't been anywhere close to that neutral market for quite some time. I just dated this back to November, nonetheless, it gives you a big enough sample size, I think, to show what's our pattern. Our pattern is we're very low. What does that mean? Prices get pushed higher. Why? Because there's more buyers and not as many homes for sale. With that said, there's been a few more homes on the market, as you can see in April 2022 versus March 2022. So hopefully that's going to be a new trend that we'll see, but time will tell. Woulda, coulda, shoulda. This gives you a quick snapshot. What does a house just over $700,000 look like when comparing the interest rate from a certain one percentage to another? That's what your monthly payment looks like. That's what the cost of waiting can be sometimes. Again, so is now a good time to buy? My question to you is, are you qualified to buy right now? If so, and you're able to get in, I don't know. I think there's two good times to plant a tree, 10 years ago and today. I don't think houses differ that much. I think we all say, oh, if I could have gotten 10 years ago, I would have. Well, if you didn't and you're looking today, my take is if you can get qualified today, talk with professionals, see if you can position yourself to get in today. There again, just paints similar picture, but gives you a bigger context. The difference in the life of the loan, that's how much you're paying, an additional $480,000 over that 30-year period, just by going from a 2.75% interest to a 6% interest. Again, not my opinion, just sharing the facts and let the chips fall where they may. It's not my job to tell you what to do. It's only my job to show you what happens if you choose not to do it. Right? Cost of waiting for prices to come down. And this is our reality now of where we see ourselves in this market. So prospective home buyers, what does this mean? What do you need to know? Pre-approval before you start looking is so vitally important. Know what your budget is and be prepared to move quick. What will you do if there's a mismatch in price? I always ask my prospective buyers that one, right? Are you willing to move a little bit farther out? Do you have that family member or friend that can help you out, right? What are you maybe willing to give up? Are you willing to give up a bedroom? Are you willing to give up that backyard? Different decisions you have to make, right? And understand why home ownership is desirable. It's not just an investment financially. It's an investment for your lifestyle, right? It's the appreciation. It's the fixed rate of that monthly payment, right? Owning a home, it's about the preferences we want. So things to be mindful of if you're that prospective home buyer trying to navigate this market to say, gosh, is this worth it? Well, is it worth it to you and your lifestyle and those around you? Local spotlight, guys, real quick. You can always hit pause and take pictures and zoom in on these ones. Just wanted to briefly share with those of you in the San Gabriel Valley. There gives you a snapshot of what April looked like for a single family home in various locations within the San Gabriel Valley. Then I go through homes sold from 500,000 to 1.5 million. Real quick, point being, we increased in the numbers of homes sold through the San Gabriel Valley. Townhomes sold, we increased that number overall. So things are moving here in the spring market. And condos also started moving a little bit more specifically in that central part of the San Gabriel Valley, being Pasadena, Monrovia, Arcadia, Azusa, Doherty. That was really the big driver because you see a lot of zeros in that graph for main numbers. Nonetheless, that central 210 corridor saw the most movement within the condo space. Your spring 2022 buyer and seller guides are here. Just shoot me an email. There's my email right there. It's no cost to you. All you have to do is reach out. So if I can help you or someone you know, by all means, I'm here for you. Last but not least, there's my goal, to help you build a happier, more proud and accomplished version of yourself through real estate. So if I can ever be of assistance to you, again, anyone you know, someone relocating here in the San Gabriel Valley, even moving within the San Gabriel Valley, I specialize working with those relocating as well as 1099 workers and first-time homebuyers. So guys, I'm here. There's my contact. Thank you for joining me on another version of my How's the Real Estate Market and my market review for you here in May 2022. Please like this, share this, leave a comment below. Let me know what you think. And again, let me know if I can ever help you in the future. Talk soon.